What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure you please subscribe. Make sure you hit that notification bell so you can be in the know every single time that I drop an episode, because I'm going to continue to drop more content to provide you more value and more information. In this episode, I'm going to be trying to explain to you all how to invest in your 401k. Now, what is your 401k? Your 401k is simply a retirement plan that is offered to you by your employer. Many employers throughout the United States offer 401k plans. They may be in the form of other names such as 403bs, 457s, thrift savings plans, and other particular savings vehicles for retirement. There are two different sides of the 401k. You got the traditional side and you got the Roth side. The traditional side is your pre-tax money. That's money that you put in pre-taxed and you pay taxes sometime in the future, way in the future. So the money that you put in, you're not taxed on that money, but you're gonna have to pay taxes on that money in the future. The Roth money is your after tax money. That's money that you've already paid taxes on. You put that into the account and it will grow tax free, and you will never have to pay any tax on that money. Now, I'm going to explain to you later in the video which side I believe you need to be on, but that is pretty much how the 401k is structured, and you can decide what type of contribution you want to make in terms of percentage to your portfolio, right? In terms of percentage in your portfolio. I'm also going to provide a recommendation on that as well. But many individuals that I've ran across, they do not know how to select an investment in their 401k. They don't even know what's in their 401k. They're putting money into it every 2 weeks, but they seriously have no idea what is in it, and they do not know how to select the best fund. So I'm going to show you how to choose the best investments for your 401k. Let's get into it. Okay, everybody, so I want to show you all the process for actually choosing your investments in your 401k, your 403b, or whatever retirement account that you have. Now, I have Principal. Principal is the custodian of my particular 401k plan, but everybody is different. Somebody could have Fidelity, somebody could have Schwab, somebody could have a random custodian that nobody knows about. But at the end of the day, the process is similar regardless of the custodian. So for this particular situation, what I do is I log into my account, I click on my plan, and then I have my investments up here at the top, and I clicked on investment performance. Now, investment performance provides all of the particular assets, or all of the particular mutual funds that I actually have access to. And I want you all to scroll down and look at the particular options that you have. We've got short-term fixed income. We've got this balanced slash asset allocation. These are your target date funds that are very popular, but I want you to scroll past those, and I want you to find your large US equity, okay? Your large US equity, and I want you to find this large cap S&P 500 index. Now, why am I such a fan of the S&P 500? The reason why is because the S&P 500 needs to be your go-to mutual fund, because when you purchase this fund, when you're putting money into this account every 2 weeks into that S&P 500, the S&P 500 has the longest and the most consistent track record in terms of stock market performance. When someone says the market is up or down on a given day, they are referring to the S&P 500. The S&P 500 is made up of the 500 largest companies in the United States stock market, which is the best stock market on earth. Now, this is something I want you to understand. Think about the total returns. Now, you have to be able to stay in this for the long term, over the long period of time, while you're investing to your 401k, reinvesting, and being able to take advantage of the compound interest. if we look at the total return for this particular S&P 500 fund, it's different for all of them, but they're about the same. Since inception, we're talking about 10.36%. That is your average, right? Just over 10% for the entire average. Over the last 10 years, we're talking about 12.89%, 5 years, 14.98%, 1 year, 29.77%, and year to date, we're talking about 12.52%. Now, when you take into account the particular fees or the expenses that you may have to pay on a particular fund, it's slightly lower than the S&P 500 index, but it's still larger than the large blend category. Now, what is the large blend category? This particular chart is giving us the difference in terms of different large blend funds that have the same type of assets, the same type of makeup that the S&P 500 has, and the S&P 500 outperforms all of those funds on average in the large blend category. So the S&P 500 is where you need to be over the long-term time horizon, okay? The S&P 500 stocks fluctuate. The top 10 in the S&P 500 10 years ago are not the same 10 years now. It doesn't mean that it will be different. The point that I'm making is that the funds and the weighting, and you don't have to pick stocks if you just get the S&P 500. If you get the S&P 500 and you hold it over the long term, you don't have to pick stocks. You don't have to figure out the winner. You don't have to figure out the loser. You can just buy this. This is going to be the longest and the most consistent track record that you have to pay attention to. Here's another reason why I want you to find the S&P 500. The S&P 500 is going to provide you A, the best return, and B, is going to provide you the most value from a cost perspective. It's going to be the cheapest. Why do I say that? If I look at all of the particular funds that I have access to, right, the S&P 500 is going to give me the lowest expense ratio, meaning it's going to cost me the least amount of money to own it, and B, I'm going to outperform all except for maybe one or two funds, right? You may have access. For example, if you are a Vanguard holder and Vanguard is your custodian, that's a great, like hats off to you. I'm glad that you have access to Vanguard, because when you have access to Vanguard, you have access to a wide array of their particular funds, so you may be able to find better value in other places and still be able to have that low expense ratio. But for a lot of our funds, like the target date funds and the large cap equity, the mid equity, and the fixed income, they're going to charge you a hefty price to be able to hold those funds, but they're going to be more expensive and they're going to underperform over the long term. Everybody wants to call out the target date funds and talk about how good they are. The problem is that they're going to underperform over the long term because of that fixed income component. That fixed income component is not 100% foolproof. It's not 100% risk off. Why? Because when you are invested into bonds, you have what we call the long-term risk. You have a long-term risk in terms of interest rate risk when you are purchasing bonds. And so if I say, hey, I'm going to get into a target date fund for a particular year, and I'm just going to just wait and just hold that until I get to my retirement age, it's a large probability that I am going to underperform over time because of that bond component. If I would have just held the S&P 500 the whole time and not deviated from that, by the time I got to retirement, I could then diversify. I could then diversify going to fixed income. But until I get to retirement, I need to be in stocks the whole way through. So again, recap, talk about this again. The S&P 500 is what you need to find, because that's the one that you can be the most consistent in. It has the most consistent track record. Select that, change your contributions and change your investments to the S&P 500 index. If you do not know how to access this, contact your employer and the group within your particular company that is in charge of creating this, because they will tell you how to access this, how to find your investment, how to find your particular investment choices, so you can make that decision and start making that investment today and start growing your returns, start growing your portfolio, start growing that 401k. Now, as I always tell you all in every single episode that I do, this is not financial advice, okay? This is not financial advice. You need to consult a professional and you need to do your own research before investing into any stock. And also, you need to consult a tax advisor before making any decisions that could affect your particular withholdings with your company, and also taxes that you may have to pay at the end of the year. But I'm just going to tell you all and just break it down in terms of my particular philosophy, my particular thesis, and what I believe. So in many 401k plans or other employer/retirement plans, your employer will typically do a 401k match or some particular match, right? And what that match does is, the match is different for every single company. Every single company is different. It could be 6%, it could be 8%, it could be 10%. Whatever that match is, you can contribute up to that particular match in terms of percentage of contribution of your salary, and the company will actually match whatever you contribute to that. So what I think you should do is, I think you should invest up to the match, whatever that match is that your employer provides, and the remainder of the money that you want to invest, you put it into accounts outside of your 401k, like a Roth IRA, like an individual brokerage account, because that provides you the opportunity to be able to select investments and trade for yourself. Now, why would you want to do that? Why would you want to trade for yourself? The reason why is because in these particular accounts, like a Roth IRA or an individual brokerage account, you have a plethora of investment options. You can decide what you want to invest in. You can invest into individual stocks if you follow the stock market very closely. You can actually have access to more ETFs and more funds. So you may want to have a technology only investment. You may want to have a consumer discretionary only investment. You may decide that you want 10 to 15% of your account to be Tesla stock. You may decide that you want 5% of it to be AMD or Nvidia. You can make whatever decision that you want. But if you put all of your money into the 401k, what's going to happen is you're going to have that restriction, and you're not going to be able to make that selection for yourself. And so what I want you to do is, I want you to take advantage of the match. I want you to take advantage of what your employer is giving you, but make sure you only contribute to that match and put it into the S&P 500. At the beginning of the video, we also talked about the traditional side and the Roth side. I am of the opinion that you should be putting whatever contributions you're putting, you should be putting those on that Roth side. Why is that? Because you may be getting taxed up front now, but here's the thing, you won't have to pay taxes on that later. And by the time you're 59 and a half, you can actually take that money out tax-free and not have to worry about the taxes at all. Now, certain professionals and certain tax advisors, they may say, hey, if you max out the 401k and you put it all on the traditional side, that will lower your taxable income. And that is true. That will lower your taxable income. But the problem is, in the future, you're going to have a hefty tax bill in what is called a RMD, which stands for required minimum distributions. When you get to 72 or 73, 74, 75, when you get into those 70s, the government is going to require that you take money out of that account because you haven't paid taxes on it yet. And Uncle Sam is going to want that money. So if you have millions of dollars in that account and millions of dollars has not been taxed, you're going to have a hefty tax bill that's going to come to you. You're going to have to pay that in that particular year. And at that point, you may not have the cash flow, you may not have the income, and you may only be living off of investment income. And so if you're only living off of investment income in retirement, what you want to do is you want to make sure that your tax rate is as low as possible. That way you don't have to worry about paying any unnecessary taxes. On top of that, I told you, don't max out the 401k. Do not max out the 401k. Only contribute up to the match. The match may be 5%, it may be 6%, whatever it is. At the end of the day, whatever match they provide to you, that match, if it's 5% or if it's 6%, that 6% is not gonna matter in the grand scheme of things in terms of lowering your tax liability. So here's what I say that you need to do. You need to contribute to your 401k, 403b, whatever it is, on the Roth side. Contribute on the Roth side and contribute up to that match, right? Up to that match. That way your employer can give you all that money, right? Your employer can give you all that money that you need. Any other free cash flow or any other investment that you want to make those outside of the 401k, in the individual brokerage, in the Roth IRA. That way you can make those decisions for yourself, and you can actually make sure that you are doing the best thing that you feel like you need to do in order to be able to grow your money. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like, please subscribe. Make sure you hit that notification bell and be in the know every single time I drop an episode. Reach out to me in the comments. I'm curious, what custodians do you have for your employer? Do you have Vanguard? Do you have Fidelity? Do you have Schwab? Do you have another random custodians that are out there that we may not know about? And let me know what type of investment options you have in your 401k, because I'm interested and I want to be able to help you all select the best ones for your 401k. As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all in the next episode.